thank you all very much for joining us. So before we get into it, I really just want to quickly go around the stage. If you can all just introduce yourselves and what you do and your interest in this particular topic.
I'm Charlie Yu, a co-founder of Castle Finance. We started as a yield aggregation protocol and recently found out that the yields that are purely on-chain were not quite good enough for a lot of our customers and started looking into more real-world assets as a result. So now we're building out a new project called RWA.xyz, which will be a data aggregator for investors looking to learn more about all the real-world assets available on-chain.
Hi, I'm Aaron. I work at Warbler Labs, which is the team building the Goldfinch protocol. We do lending to real-world assets, primarily to credit funds and fintechs, with about 80% of our exposure in emerging markets. And yeah, excited to chat on the panel.
Hi there, my name is Gabe. I'm an institutional DeFi. I'm a DeFi investor with an institutional stealth crypto fund. And I'm interested in real-world assets, in the opportunities they can bring to the DeFi space overall.
Hey, I'm Colin Cunningham, and I do business development over at Centrifuge. We're building a decentralized protocol for financing real-world assets on chain.
Awesome, thank you. And so I really wanted to just get things started by laying some ground rules, defining what we're talking about. So I just want to throw it to you. What does a real-world asset on DeFi look like? And then also, by the same token, what does it mean to be a decentralized protocol? What does decentralization look like when we're talking about real-world assets? And let me just start with you, Charlie, and we'll go down.
Sure. So I think that it's the definition of a real-world asset in the context of crypto is anything that derives its yield not purely from just only bits on chain. It's something that's connected to real-world lending or something that makes an impact in not just the tiny area of crypto that we find ourselves in.
Yeah, I would say from our perspective, real-world assets should be exposure not only to the real world, not just to businesses, but businesses outside the crypto sphere. Like I talk to a lot of our borrowers and sometimes I'm like, oh, how do you feel about the crypto crash? And they're like, what crypto crash? That's the kind of level I want them to understand what crypto is. So yeah, I think that's kind of how I think about real world assets. And then in terms of what it actually looks like on our platform is it's actually quite simple. It's just normal real world loan docs that are denominated in USDC instead of dollars and are paid onto a protocol instead of into a bank account.
I think at our firm we have multiple perspectives of what a real-world asset will be. However, I would argue to me a real-world asset is an asset that touches a physical asset in the real world that from which humans derive value.
Obviously, I think RWAs have people look at them a little bit differently. I think it's still emerging how we define and how we think about coming to consensus around that, I guess. For us at Centrifuge, we think about it simply as private structured credit from your traditional markets. And I think to the question around decentralization, the way we think about that at Centrifuge is building kind of a community around this protocol and all of the different players that you might find in traditional finance or find off-chain in private structured credit. Talking to those people and helping those people understand the value of transacting on-chain.
So Charlie kind of touched on this before, but Aaron, you were just mentioning, it's denominated in USDC and similar things. Why? What's the advantage that you see that your, investors and your customers and your clients see in denominating these things in USDC and putting this on some kind of a crypto platform versus just going to a bank or going to wherever their traditional financial institution and asking them to put a loan doc or structured or note together?
Yeah, it's a great question. I think it falls into two camps of how the DeFi approach really matters here. One is that I personally think USDC and USD are different asset classes. People aren't arbitraging these opportunities out, and there's a massive amount of wealth that sits in stablecoin that's ready to be deployed. And just for example, I used to work doing something very similar in the traditional finance sector. It took my firm 3 to 4 years to raise a $100 million fund to deploy. The last deal I did on Goldfinch, or helped a borrower bring on Goldfinch, was a $10 million deal, and it closed in less than 2 hours. So like from a traditional finance perspective, that's just mind-blowing for these clients. The second thing is that taking a DeFi approach basically means that you get a chance to cut out all the intermediaries and ask the questions that when you're sitting in a traditional finance firm, you kind of like begrudgingly accept and end up doing 70% of the work that you don't actually think moves the needle very much. And so compared to a traditional finance situation where you have to go find LPs, you have to set up an offshore structure, you have to pay the credit firm is profit incentivized to charge you as much as possible, you have to hire advisors. It's just like, here's the lenders, here's the borrowers, see whether they trade. And the final thing I'll say that's a bit of a caveat to both those points is that I also think crypto investors have a better risk tolerance. So like traditional finance has effectively created these funnels that put credit or put money into like very commoditized type of credits like bonds and S&P 500 and all that, but it's not actually incentivized to look at where there's real growth and real yield. And so we present this thesis of like, we think fintechs and emerging markets are a great credit that banks don't want to underwrite. And people are like, yeah, I kind of agree. And you're giving me 17% for a junior position here. Like, this is actually a really good deal. And I'm willing to kind of step outside the biases of traditional finance and put money to work. So I think the product itself, from like ease of funding as well as complexity of the process, is just like game changing. I've had some of our borrowers tell me like, if this is true and we can scale our debt on your platform, like I will stop talking to traditional credit funds altogether.
And are the rest of you all seeing similar kinds of interest from potential investors in this asset class?
I can jump in with, I think Aaron's point's well made. I also think, USDC is one example of a stable coin, but the emergence, or not even the emergence, but the existence of MakerDAO's DAI stable coin, and obviously Aave now has their own plans on the stable coin front. I kind of look at it, and I think most of us probably would agree, it's a team effort, right? Like the work they're doing, the education that they're kind of leading the institutional world through, that's creating the opportunity for RWAs to even exist. And so there's a lot of collaboration and coordination, I would say, within DeFi to see all boats rise.
And to underscore a point that Aaron was also making before, I think it's pretty common in traditional credit funds to actually have more back office people than front office people, just because of the operational intensity that exists in a lot of these, in private credit in general, when you have to worry about payments getting to the right people, especially if they have coupons involved, and you have like at least 5 different outsourced other functions, and you might have maybe only 3 people in the investment team and 6 other people working for you on the ops side. And what DeFi really gives you is the opportunity to eliminate most of that busy work and be able to quote tighter spreads and offer a better product for everyone.
Yeah, I would argue that from an institutional side, we definitely are seeing more increased demand to real world assets. However, I would argue that we can think of the market cap of gold being $7 trillion. Really nothing close to the scale of what we could be seeing in real world assets. And I think that in the next cycle, that real world assets will make a very significant impact in the overall liquidity of crypto overall, whether it be through security tokens or through simply tokenized assets on chain.
Maybe, I'd really love for you to expand on that. What are some of the impediments? What are some of the hurdles that have to be overcome to really get there? Or is it just a matter of time? The interest is there, people are starting, and now it's just waiting for the money to flow in?
Well, I think one of the biggest questions in making this is going to be regulatory. Being able to offer redemption certificates for real world assets. We can think about the US dollar as a redemption certificate for oil right now. The amount of power that centralized governments have on real world assets is immense. And so we're going to have to be working with regulators to make this tokenized a reality, no matter how we do that. Whether or not we're going to be able to get enough regulators to endorse a trustless solution is yet to be seen. However, I do hope that we can work with the industry, can work with regulators in multiple nations, countries, and states for this to be the case.
The other thing I would add that from like our efforts to pitch institutions, I feel like the offering is almost like awkwardly in between good for crypto natives and good for institutions. And there are some things that they don't really like. So for example, institutions, we basically double up our yields that we get from real world loans with token airdrops for early contributors. Our institutional investors are like, I don't want crypto on my balance sheet. Can you just not give me these rewards? And it's like, what? We thought this was a really big, appealing part of the value prop. So I think it's just like marrying these two worlds, getting crypto to understand real world assets a little bit so that we can pitch it more confidently. The other thing that I would say that if I was in the shoes of an institutional investor is uniquely risky about crypto is just security risk, right? You go look online and there's crazy hacks all the time, and it's hard, like everyone's audited by the same firms. It's hard to know who's like actually a very secure protocol and not. So I think that's something that they're getting their heads around as well.
From the, just kind of expanding on the regulatory side of it, obviously my background's in regulatory, so key area of interest. But, when you're talking about the risk of hacks, the risk of scams, what are some of the questions that you're seeing, actually asked by regulatory agencies? Is it very specifically tied to the risk to investors? Are they expressing interest in this at all? Is it something that they're saying, well, if you do X, Y, Z, we'll be, open to chats? Or is it still just a closed door right now? That's the panel.
I would say things are still very much in a gray area. And the fact that regulators haven't even really addressed the issue of security head on suggests that it's more kind of like something that sits in people's mind, like, oh, I'm a little scared of this new technology. So I think we need to more proactively address it. Like, I've done a lot of like country by country regulatory analysis to get our borrowers comfortable. And so many of the answers you get are kind of like, yeah, this is possible, but the regulators haven't really commented on X, Y, and Z, and there's potential risk there.
Yeah, as far as I know, the only country that's explicitly tied token legal rights to the real court legal rights is in Switzerland, where they passed the DLT law or DLT Act late last year, which establishes a precedent for tokens to actually be treated as ownership of real things. And I think that's a really good first step, but of course, like you said, a lot of other countries need to start adopting laws like that in order for the space to grow.
I was just going to say, I think because you're naturally dealing in real world assets, right, that you're trying to bring on chain, a lot of times you're already fitting within the existing regulatory frameworks that exist, right? And so I think that's the responsibility of both the participants that are trying to finance real world assets on chain and the protocols that are working with those groups and those communities to just make sure those people are in line with the existing frameworks. And I think it usually comes down to, how are you issuing the debt, right? And then who are you issuing the debt to? And what are the kind of the pieces of the puzzle that you put in place? So whether that be third-party KYC providers and things of that nature, just to ensure you're following the existing frameworks. I think it hasn't been, at least on that side, there hasn't been much pushback or friction to this point.
So where do you, to the panel, but where do you see kind of some of these, advantages maybe? Where do you see progress happening, not just necessarily on a regulatory front, but on a, people think that maybe this platform looks like it's secure, is audited, is, something people can be comfortable with, or is that just not a thing yet?
I think if the product is good enough, people will get on board and do the work to understand things. So like, I'll use Singapore as an example. We just did a deal with a Singaporean company, incredibly high regulatory standards. Like you have to tick and tie absolutely everything. And so doing that first deal is tough. But after that, there's just been an absolute wave of borrowers who are now waiting for us to lend to them. And I think it comes back to, it's a cheaper product, it's faster to execution. So if the product sells itself, you will get that interest. It's just about breaking that first door down.
I kind of break it into two pieces. I think there's kind of the product side of a protocol, and then there's the platform side. I think on the product side, you're talking about recreating, rebuilding as much as possible with Web3 tooling, the entire end-to-end credit journey, right? That's from digitization to tokenization to securitization, and ultimately servicing and reporting on the debt that you're issuing. I think there's a great opportunity there, and I think some of the early adopters, RWAs is in a very nascent space, see that as kind of an immediate but maybe a minor value proposition. I ultimately think the major value proposition, at least as we're seeing it today, is through stablecoins, right? And the cost of capital that can come through that, and that comes through leverage that's generated through those stablecoin providers. And so, back to my original point around kind of teamwork and all boats rise, as stablecoins continue to proliferate and grow, and hopefully continue to do the right things within the regulatory frameworks, provides immense opportunity for insurance companies, pension funds, sovereign wealth funds who are already on chain, benefiting from all the other value propositions that stablecoins offer. Once they're on chain, where else can they allocate their capital? And if they want to avoid the volatility of the crypto space, RWAs are again, nascent, but I think fast growing opportunity for those institutional players.
So I want to kind of get into the stablecoin side of it in particular. Earlier, you were mentioning some of the decentralized stablecoins that have been growing, especially in the last 2 or 3 years or so. But obviously, as we've seen earlier this year, just a few months ago, not all stablecoins are stable. So how are you looking at the kind of, the risk in terms of, is a stablecoin structured in such a way that it's not going to collapse because of, XYZ factors? Gabe, let me get you in here on this one, just to start with, and then go out anywhere. But yeah, I mean, how do we avoid Terra 2.0, basically?
Well, I think there's two questions, right? Does the stablecoin maintain a peg? And does the existing mechanisms of the stablecoin cause the asset itself to drop to zero? I think we've seen time and time again that using an algorithmic stablecoin of some kind may not be the best way forward. However, I also think about the question of, does a stablecoin really need to be worth $1 at all times, right? Why do we even consider the concept of stability to be the US dollar? The price of food and every single thing on this that we use every single day is increasing steadily. And the US dollar has been the most unstable asset in modern history, in the sense of it is continuously depreciating. I would argue that solutions like Frax and other inflation-adjusted stablecoins may be our superior model going into the future. And if you can think about it as it ties back to real-world assets, we haven't really seen a major stablecoin so far yet be tied to the value of the real-world asset it's backing. And I think that could be another powerful solution.
I think it's a good time to bring up the idea of DAI as the stablecoin and MakerDAO, especially with Colin here from Centrifuge. I know you do a lot of loans with in partnership with MakerDAO denominated in DAI. Love to hear more about, DAI is backed by a lot of these real-world assets now, or at least will be more increasingly. How did you decide that, or how did your team decide that DAI was able to be used for these?
Well, the Centrifuge story goes back to late 2017. So we've been around a while trying to figure this out. The preeminent partner 3 years ago when we started on that journey was MakerDAO, right? And obviously, a lot of stable coins have come and go in that time. But the general thinking was, it's the best partner in class and decentralized in nature at the time that we were thinking about building the protocol. MakerDAO is, and everything that MakerDAO is, it's never a dull day in Makerland, I would say. But I also think that a lot of the work that they're doing, and they're an important partner of the Centrifuge protocol, I think it's pretty groundbreaking. right? And I think that I don't know if I would fight a battle on as many fronts as the MakerDAO community and protocol does. But when you think about really kind of pushing the envelope and even some of the ideas I think Gabe was talking about, there's no shortage of ideas and energy within the MakerDAO community and the protocol. So continue to be excited to see what they do, but I would just say that there's other solutions out there, whether it be USDC or other stable coins that are coming. So, but yeah, that was the genesis of that partnership.
Yeah, I would just say on this, I mean, we've selected to use USDC because we think that's going to attract the most investors. But I think the most important thing is that your choice of stablecoin is really about investor risk preference, right? Because, if we're trying to attract people that are interested in USDC or more decentralized stablecoins, it's really the investor's risk. They understand that crypto stablecoins are kind of a risky investment, right? Whereas on the borrower side of things, stablecoins always break down. And so our borrowers are like, oh, stablecoin's gonna break down? That's great. I have to pay 20 cents on the dollar for this loan. And so it actually is quite a good separation of risk to the people who actually are making the investments and understand the risks of stablecoins. The reason we choose the kind of like one-to-one backed, the one we think is the best one to go for in the centralized space, is because we just think that's where investor demand is gonna be.
So I want to maybe switch gears a tiny bit. One of the things we were, briefly discussing before the panel is this idea of trade-offs in real-world assets on DeFi versus, kind of more quote-unquote traditional DeFi products. And I was curious, how are you approaching these? Whoever wants to start.
Is the question just kind of like the existing model of DeFi versus the new model of DeFi? What's the difference?
Yeah, like, when you're talking about putting a real-world asset on DeFi, you're tying something physical or something that has existed in the traditional world for forever, versus in DeFi, a lot of what we've seen is kind of these novel things that regulators are still trying to even define, let alone wrap their heads around.
Yeah, I think of like what most people consider DeFi, this kind of like auto liquidating loans and things like that, as like money markets effectively, right? Like you need instant liquidity, but if you believe that you can have instant liquidity and 20% APRs at the same time, like, no, like you can't. It's just VC subsidized yield or ways to bootstrap, which is not a criticism of any of that. It's really helped a lot of protocols bootstrap, but to think you're gonna get that forever is kind of ridiculous, because to actually get yield on an asset, you have to give it time to be put to work. I can't give someone $1 tomorrow and be like, oh, can I have that 20 basis points of return that you should have gotten me in a day? So I think that's kind of the key difference in my perspective. Like old school DeFi is looking more at market and liquidity risk, whereas new school DeFi is kind of, or real world asset DeFi is looking at credit risk and counterparty risk. And I think those are different challenges, but probably more sustainable long-term in actually getting money back to people that's based on real world yields.
I think it's also worth considering here the scale of what DeFi is now versus what it could be when you have many real-world assets, where all of DeFi TVL, I believe, is at maybe $50 billion or $50 to $100 billion. Whereas when you look at the real-world asset space, just private credit itself is many, many trillions. And just bringing that on, I mean, that seems like by far the most popular, or at least has the highest product market fit in DeFi so far. Just bringing that sector on chain, not even to mention equities and other sorts of credit opportunities, increases the total market size of DeFi by like 1,000 to 10,000x. And so, of course, DeFi will need to change and progress in order to bring that sense of scale.
I think it's also important to note that, both the combination of private credit markets and real-world assets and also the tokenization of commodities presents an interesting opportunity for DeFi and may present interesting opportunities that we're not necessarily used to in traditional markets. Thinking about the idea of creating a liquidity provisioning position on Uniswap for some form of tokenized oil versus for some sort of crypto asset or some form of tokenized security could be very powerful. And so I think the opportunities for DeFi in real world assets really could expand what we think of traditional financial markets applying in what we see right now.
Yeah, in that space, something that really excites me is the idea in the future that we could do currency hedges on chain. Because that's like an asset that every time you get quoted it, you get pretty screwed on price because, as Charlie was saying, you're paying the OPEX of this Goldman trader who's getting a crazy bonus, and like that has to be factored into the price. But 1-year forward rates are observable on blueprint.com. So like, why are we paying any different than what that 1-year forward rate is? I just think there's lots of like kind of old school traditional finance conventions that can really be disrupted on chain.
Yeah, I was just going to say, I think when you think about kind of the educational journey that we're going on within DeFi, right, and specific to credit, there's just behaviors and like philosophy that's inherent to DeFi that I think is, it doesn't necessarily initially jive with the world of traditional credit the way you might think. But I actually think there's some really interesting things emerging, like potentially secondary markets, right, that could actually be really interesting on chain for real world assets. And I actually think fit really nicely into a lot of the DeFi behavior you see, right? The ability to trade it. You don't have to hold it for a certain amount of time. So there may be like primary debt markets, right, which may be more institutional and maybe less a fit for the current DeFi community. But as real world assets grow, there will be secondary markets, right? There'll be trading markets around that I think is very naturally aligned to some of the behavior that you see in DeFi today.
Yeah, I just want to add on that, like, I think the secondary trading portion is a really interesting aspect of real world asset DeFi because traditional finance like puts up walls. Effectively, it's incredibly hard to trade positions once you originate them, and it's incredibly hard to get in as a retail person. I'm sure come to a company with $1 million or more, they're just not going to wake up. And so having the ability to not only have on-ramps for retail to be invested in these things, but then also just full transferability rights and be able to trade this on secondary markets mean these like highly bespoke private credit deals that have been giving really good returns to private firms for a long time have been democratized.
How are you all looking at the kind of, on the secondary market or even just kind of generally this retail market? How are you looking at the size of this potential audience? Is it, have you seen interest from, or have you heard of, everyday retail traders expressing a lot of interest who are, currently unable to access these markets? Or is it, once again, just kind of more a matter of time, and as these markets mature, the investors will come?
I think one interesting lesson from the meme stock craze of early last year is that people can find really anything to get excited to invest in, retail traders specifically, as long as there's a good meme around it. I mean, like, why GameStop, why AMC? There's, of course, much more sexy tech stocks out there, but for some reason, because of the memes out there, those are what captured the public's imagination. And so it's all about the marketability of these things at the end of the day. And I think, although there are obviously different aspects of the upside and downside potentials where it's capped in a lot of in credit in general, that makes it less of a good asset for retail. But certainly, you can still get really good returns. I mean, especially in more distressed assets that I think retail could get excited about.
Yeah, I think retail is actually a really important part of this, and especially bootstrapping with like crypto native people initially. Like I was saying before, in this previous fund we were working on, it takes 4 years to raise $100 million, and you probably need like 3 or 4 investors. Goldfinch grew from 1 million AUM a year ago to $100 million today, based on basically, well, mainly retail money, non-US retail money. That was the only money we accepted initially. And so going from 1 million AUM to 100 million AUM based on retail checks that on average were like $5,000 is like ludicrous in traditional finance world. I think, it's harder to scale that way. We need to, for the next 10x and then 10x after that, you need institutional money. But I think there is a big power of retail, and retail really buying the thesis of like, wow, I never had access to these deals before.
I mean, I would argue, though, that there are some real-world assets where we can see strong demand from retail, fueling speculation from institutions as well. I think freshwater resources would be one example of an asset that we see significant institutional demand for. However, subsequently in that nature, we could easily see such demand from retail audiences as well, and vice versa, with a notable example being Harvard's endowment fund specifically. If we can think of the tokenization of water, then if we can think of actually representing these freshwater assets on chain, I think that there is a scenario, especially in water deprived regions, for some sort of desire to hedge one's own natural supply of fresh drinking water using these assets. And there may be, in the coming years, with climate change and other deprivations of water, fresh water resources to many regions of the world, this demand just increasing.
Yeah, it's a really strong point on green assets. I think they a really great asset class specific for DeFi. I think it garners a lot of interest and creates a lot of healthy debate. I think for the Centrifuge side, I think it's more institutional in nature, especially on kind of the like the primary debt, right, and the issuers that we're seeing. And I think over time, as more debt comes on chain, that'll lead the way into secondary markets, which I think will lead into kind of more the retail or individual participation in the asset class.
So just gonna maybe get a slightly not off topic, but slightly adjacent. One of the things I've noticed about a lot of DeFi projects is that there's no real way to differentiate between retail versus an institutional investor besides volume, right? Anyone has the same amount of access that anyone else could have, and so I'm really curious. Are you do you have to look at the kind of how you're offering this differently? Because of course, one of the big issues we've been hearing from regulators is this idea of consumer protection and making sure that retail investors don't get involved in something they don't fully understand. Is that a consideration at all, or how do you approach that? I guess let's start with you.
Yeah, I can jump in. I think from our side, we use a KYC provider, and especially in the U.S., right? Anybody that wants to invest has to be an accredited investor, right? And that's kind of and that's where it goes back to the original point, right? About if you're fitting into the existing regulations that exist. So that's short answer, but I think the right answer, at least on our side.
We do the same, and that's why we started with non-US retail initially, because getting accredited investors in US regulations is kind of a scary, hard to understand place. But now we also accept accredited investors that have to go through KYC processes.
We do as well as a hedge fund. However, I do think that there should be some changes to the laws for who can invest in these types of vehicles, showing sophistication. And I think we'll follow the laws as they exist, but I think that those who should lobby for something different should.
Charlie, do you want to have any thoughts on this?
So we're just getting started in this in the real world asset space, but previously our yield aggregator did not do any KYC, and that obviously limited the set of options that we were able to source yield from. And yeah, we'll see where that takes us. It seems like a lot of the KYC solutions right now are not necessarily composable with the rest of DeFi. So I think generally that's a pretty interesting space to be building in, and might be something we pursue.
It'll also be interesting to see when secondary markets come out, whether that also requires KYC or if you can trade positions before redeeming them. That's something that we spend a lot of time thinking about. But yeah, KYC is something we spent definitely a lot of time. It's hard to get your head around. And again, some of the regulatory guidance isn't exactly clear.
And are you seeing like a huge difference between the US as a market and then non-US countries, and the potential investors overseas?
Yeah, we're seeing quite a difference, and it's quite interesting that we got to kind of test the non-US market initially. I think a lot more of the institutional money will come from developed markets like the US, but a lot of our initial growth was bootstrapped from all across the world. I would say a difficult thing about this relative to TradFi is it's pretty hard to actually do analytics on this, right? Like we try and talk to our investors and be like, oh, which country you from? How did you learn about us? All this kind of stuff, but like forming a very clear overall picture and putting it in Excel is just not that easy. So ask me again in a year, maybe I'll have more insight for you.
I mean, the majority of the issuers that you see on the Centrifuge protocol are US based. And so I think that's been kind of a key part of our growth. Obviously, those issuers could come from anywhere, but I think to Aaron's point, right, like a lot of the the institutional money and probably the institutional debt, at least in these early days, right? It goes back to your point about like the size of like the private structured credit markets versus what we see between a couple of protocols today. Like we're not even scratching the surface. I don't know what a good analogy is, but we're really just getting started. So a year, 2 years, 3 years, it's gonna change geographically, I think, as the space emerges.
So, kind of going back onto the main topic, I know we talked about this briefly at the beginning of this panel, but just this idea of comparing real world assets on DeFi versus people just investing in real world assets through traditional markets. Besides kind of the regulatory acceptance part and the institutional, the amount of money people are willing to put into it, are you seeing any major differences in just the approach to, RWA on DeFi versus not?
Yeah, I mean, I can jump in with some thoughts here. I think going back to MakerDAO, a lot of the conversations, I love the work that we do with MakerDAO because one, it's all public, and two, you get to see a lot of the thinking, both from the community and the appointed experts or core units within MakerDAO and how they think about things. And I think kind of having a liquidation preference, right, is really important. I think being able to quickly move in and out of things is important. And I think that gives us some insight into, and then how do we evaluate credit on chain, right? And how do we get the right people around the table to underwrite, structure, price, private structured credit on chain is not an easy thing. And so I think a lot of that, the way I kind of think about it is in DeFi, we're always talking about kind of the world of structured credit, right? And like what goes into that? How do we all build this together in DeFi? And then I think on the TradFi side, right, I think we're trying to talk a lot about like the vision of the future, right? Like where we are today, what works today, what needs to be improved today, but then finding the right, I don't think about the institutions as users or customers. I really think about them as partners, right? We need to find those early stage visionary TradFi partners that aren't looking at either TVL today in RWAs or the infrastructure that exists today. They're thinking, where can this go, right? And they're thinking more from first principles about the blockchain, right, and cryptography. They're not saying, what do you have for me today? Because if you're asking, what do you have for me today, and from a TradFi angle, looking at the world of RWAs on chain, I think you're probably not impressed, or you're probably wanting more, versus some of these visionary partners really kind of have a view on the next 5 to 10 years and want to be early to that story.
Yeah, and I would also say like these people who can underwrite in the real world all have like pretty thematic like investment theses, right? Like with the lending to fintechs, there's like a whole growing industry of people who just believe banks don't underwrite these guys right. We think this is great risk reward. And so if you create a protocol that kind of has full real world assets, full private credit exposure, you do have to find the individuals within the community that you can trust and actually know how to underwrite this deal very specifically, because, a top quartile deal in that space versus a bottom quartile deal are totally in different credits. And so I think figuring out the themes as well as how you like give people exposure to different types of asset classes and how you like bundle that up is going to be something that we have to figure out. And any community driven, like what is the strategy, how are we going to expand this into all different types of assets, leads to a lot of coordination challenges.
To what extent is the fact that MakerDAO has a governance process? To what extent is that a factor in when you're kind of approaching these products? Is that do you have to consider, okay, well, there's going to be a process where it's proposed, and then the various token holders are going to have to review and then vote and then come to an agreement? Is it faster and more efficient or less efficient than if you were to approach it from more of a traditional company, for example?
I don't know, is the short answer, in the sense that I think the nature of when you think about institutional groups, right, or DeFi protocols that are leading the way in investing into real world assets on chain, native to DeFi, like MakerDAO is really the only group in town, right, that I can find doing it. I can see doing it. It doesn't mean we're not talking, right, to TradFi institutions and having those conversations, but kind of goes back to the point I just made, right, about some of the complexities of, you know, where we're at in our journey in real world assets versus where we could be. So it's about finding those TradFi visionaries. I do think that's why the emergence of you know, Aave launching their stablecoin, and then also, you know, even Circle, right, and the work they're doing and speaking to and getting institutions to back their stablecoin and TradFi. Those are really interesting conversations, right? Because then you're really plugging into and working with, I would say, groups that are not full DeFi, right? But let's call them just CeFi, right? Like these centralized groups that are leveraging the blockchain, that have the TradFi relationships and the TradFi trusts, and to all the questions and dialogue about regulation, they're also doing that work, right? They're going down to DC. They have the balance sheets, they have the teams, they've gone through like the lobbying efforts or whatever it takes. So that's a really interesting group because they can get their head around crypto, and they are already very deep into kind of the webs of TradFi relationships specific to credit.
I also think it's like incredibly challenging to bring private credit into a DeFi context because it's like one of the most CeFi industries you could even ever imagine. And so I think there needs to be points of like centralization or delegation of responsibilities. Because if you're just like having a big discussion of like, oh, which asset should we do next? And it goes off in this direction, and then someone just like, oh, well, let's like wax lyrical about the philosophy of this thing. And you know, that just doesn't work. You have to get to a point where you're like, this person knows about collections. This person will go and check that the legal documents are signed. Like there's just so many things that you have to execute quickly that unless you divvy up those responsibilities effectively within your decentralized space, but with specific actors, you're gonna have a hard time making real decisions.
I would, however, argue that within decentralized organizations, DAOs, as people call them, there is the possibility of utilizing more centralized sub-DAOs, centralized organizations within a larger DAO, where you have these sorts of, you know, expertise within each individual financial product to be able to provide that centralized authority, that centralized structure, but then be able to bring something out for broader governance on top of that. I do think that that is an opportunity, and I do think that Aave has been one of the best pioneers in this kind of process of creating a sub-DAO with centralized decision-making authority to get things done.
Yeah, and I really like these DAOs that are like basically taking people from centralized organizations and basically giving them the power to plug into different protocols, right? Like, would I rather pay a law firm 10 times the price than paying one of their associates, and the associate gets paid 3 times as much as they would in their salary? Like, why do we need the law firm to be the one to draft these documents? And so I think there's gonna be a big move in decentralization in general. You'll see a lot of people like quitting credit funds to go do credit analysis grants on protocols. You'll have lawyers doing the same, enforcement agents doing the same. So it's gonna have to be like a sea change of like really empowering those people, but there are some pretty interesting like worker DAOs that are coming up that I think are pretty promising.
Yeah, DAOs are very much still finding product market fit amongst themselves. I mean, it's only really emerged as a concept in the last few years. And if you spend time in the vast majority of DAOs, they're quite dysfunctional. But yet we still have these great things that are able to come out of it, even in that, even amongst that dysfunction and tough coordination as a whole. So I think, yeah, I would agree. Once they are able to get their processes together, get more tools together, I think the future for decentralized DAOs in DeFi, real-world assets is super bright.
So by my watch, we have somewhere between, I think, 15 and 20 minutes left. And before my next question, I just want to let the audience know that we will be doing audience questions. So please start thinking about them, and we'll start coming to you in just a few minutes. I guess right before we get to the audience, one thing I've been curious about is, I mentioned the question about stablecoin collapse earlier, but the other side of, of what we've seen this year is this idea of a contagion risk, where something collapses and all of a sudden everything's falling apart. And we've seen in some of the real world asset markets over the last 2 years or so. I think there is a risk of, for example, in commercial paper, we've seen things like Evergrande come. I'm not sure if they ever actually did fully collapse, but they came right up to the cusp of that. And so I'm curious, what kind of work has to go in on, on your part perhaps, to ensure that there is no potential contagion risk, or if there is something that looks like it might collapse, that it can be contained before we start seeing companies say, oh well, now we're out of money, we got to go declare bankruptcy, or we have to restructure. What kind of due diligence maybe, or what kind of work can you go into just avoiding that?
The great thing about DeFi is that everything is out in the open on a blockchain. So you could see in the orthogonal pool in Maple with the recent Babel default exactly how that was going to affect almost everything downstream. And imagine now in a world where we have a bunch of things being built on top of Maple, Goldfinch, Centrifuge, you can actually model like extremely precisely all the downstream effects from that default as almost as soon as it happens, as soon as it's that is written off. And so, but the problem you still have is that you need to be able to have that data on chain in the first place. And a big barrier to that currently is privacy, where in TradFi, of course, you don't want to, or in general finance, you don't want to expose the state of every single one of your borrowers' balance sheets on chain, as good as that would be for transparency. And so I think once we start seeing a lot more of this privacy, ZK tech starting to come up, we can, of course, prove things about the balance sheet without having full knowledge of them out in the open. I think that'll be extremely powerful for modeling all the downstream effects and being able to get to those and stop those contagion risks before they happen.
Well, I was also going to say just that I think like it's almost like a whole broad crypto community thing, what people care about, right? Like if people demand transparency, firms will have to be transparent. There was all these questions about USDT and like, their commercial paper investments, and now they publish these audit reports. So like there was a good outcome. I also just think people have to get smarter after being burned so much on stablecoins. Like we do have to do our diligence, and on this commercial paper stuff, I think you probably, if there is any loss on these things, I think you'll start to see a lot of stablecoins that are only backed by cash. And in fact, there are some out there already. So yeah, I think the crypto community, like, will just start getting smarter about stablecoins and knowing they have to do their diligence. And like, when I saw UST, I would always get to the end of these threads and be like, isn't this like, a death spiral? And I'm like, oh, never mind. There's so many other things to focus on in crypto. And I just like didn't spend the time. And I just think people are going to start spending that time.
I mean, I would also argue that part of the promise of blockchain transparency or blockchain technology was the open transparency it would provide. If we can use the blockchain if we can use on-chain technology and supply chain to figure out exactly when individual crates and other sorts of supplies are going to be from one place to another, I see no reason why we cannot use the same technology to prove that assets are in a particular location. I think many entities and organizations are actually doing this right now, with including, I believe, Chainlink and proof of reserves. So I think that I hope that the community will, in the long run, embrace these kinds of technologies further to better back stablecoins.
Yeah, I would combine 2 points, right? Which is, the idea of asset level data, right? I think is actually the long-term vision for real world assets, right? Like the performance of a 30-year mortgage, right? How it's issued, how it performs, who holds it, how it trades over the duration of that asset. You couple that with public blockchains, right? A single ledger connecting all these different disparate databases that exist today. That's where you start to get some level of insight, some level of trust, if you will, into the performance of those assets at an individual level. So I think we talk about those visionary partners, like, I think they see that, and I think they're willing to come build that now.
Fair enough. And so, yeah, I'd like to turn to if there's any audience questions. Yes, in the corner there, please. There should be a volunteer with a microphone, but
I can jump in with some thoughts. I think, at least from the institutional perspective, we're already seeing real estate move on chain. There's a group on Centrifuge called New Silver that has about 30 million in assets under management, and the predominant amount of money that they're taking to fund those assets is through MakerDAO, through a MakerDAO vault. So I think you're already seeing the asset class, get some exposure on chain, but it's in an institutional or through a securitized nature, right? I think real estate as an asset class is really interesting just because of the depth and the size of it, and so I think it provides an immense opportunity for real world assets to grow very quickly. But given the way the question was structured, I think you're thinking about it more in the context of like a retail nature, right? Or the individual house owner, or the owner or the holder of that mortgage at an individual level. I don't have much insight there. I can't be very helpful. But that's, I guess what I would say is real estate and the securitization of mortgages is already moving on chain in an institutional nature.
I mean, so a lot of what I think you're looking for is the ability to tokenize your own house or property. Like that would be a security token, and the industry has long thought meaningful access to issue essentially parts of a mortgage on chain, being able to be traded by non-institutional players. I think it's very much a very bound regulatory question. And the solution that I think you're looking for, where you can just buy a token of a house, or you can simply create a CDP yourself on your own home very quickly, is going to take some time and will require much more lobbying on the congressional level.
In addition to the regulatory hurdles that Gabe just mentioned, the structure of a mortgage itself doesn't really lend itself to the operational efficiencies that can be gained by bringing these assets on chain. Just compare it to something like trade finance, where your average receivable is being financed for 30, 60, 90 days. It's an extremely high turnover asset class where you can reap the benefits of that, of the operational gains, like every single month, every single 2 months, versus a 30-year mortgage where you just do that underwriting once and then it's just serviced over the next 30 years without that many other things that need to be done with it, simplifying it, of course. And so I think that's just, mortgages kind of lend themselves to being brought on chain later after it's already been proven out with an asset class in debt that's where you can get more of those efficiency gains.
Awesome. So unfortunately, that is the time that we have today, but I want to once again thank Charlie, Aaron, Gabe, and Colin for being up here, and I want to thank all of you for joining us, and thank you to the DeFiCon organizers. I think it was a great panel.
Thank you.
Thank you.